What is a mortgage? Simply put, a mortgage is a type of loan that helps people buy a house. It's a financial agreement between the borrower, so the person buying the home, and a lender, usually a bank or building society. The lender provides the money needed to purchase a property, and in return, the borrower agrees to make monthly payments to pay off that loan. These payments are called mortgage payments and are usually monthly payments across a span of roughly 15 to 30 years. Many people today can't afford to purchase a property using their own money, as the average house price is roughly £285,000 in the UK, and households typically have savings of around £7,000, leaving a massive gap between the price of a property and the money people have to spend on one. And this is where a mortgage comes into play. A mortgage is a loan that covers a large part of the property's purchase price. Most house purchases consist of a deposit and a mortgage. Imagine you found a house that you want to buy that costs £200,000. You have £20,000 to use as a deposit, and the other £180,000 would be borrowed from the bank in the form of a mortgage. Obtaining a mortgage means that someone can purchase their own property without having 100% of the funds themselves. In return for the bank providing you with a mortgage, they expect monthly repayments plus interest until the mortgage has been repaid in full. So a mortgage sounds great. It's letting people get onto the property ladder without having all the money themselves. However, let's look at the lifetime cost of a typical mortgage. Let's use the previous example of a buyer that has a £20,000 deposit and a £180,000 mortgage on a property worth £200,000. With HSBC, that scenario of a 10% deposit will qualify them for a mortgage that has an interest rate of 5.54%, resulting in monthly mortgage payments of £1,110 a month. If this mortgage was agreed over a typical 25-year period, and that rate applied to the full term of the loan, then the buyer would end up repaying £332,898 back to the bank. This means that by the time the homeowner has repaid the mortgage in full, they will have repaid £152,898 more than they borrowed, making a mortgage costly for a buyer but extremely lucrative for the banks. Another thing to take note of is that just like any other form of borrowing, the bank or building society will want to do a financial check on your situation before allowing you to take out a mortgage. They typically look at your income and your credit history and whether you're going to be able to afford to make the repayments on that mortgage. And because the mortgage itself is secured against the property, if you fail to make these repayments, then your home could be repossessed by the bank to be sold to recoup any losses they've incurred from you defaulting on that debt, effectively leaving you homeless. Unfortunately, with house prices continuing to rise and the cost of living increasing, it doesn't look like we're going to have an alternative to a mortgage anytime soon.